Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And today's free tip is, it's a good one. The more versed you are in multiple facets of life, the better investor you will be. See, most people in the world of investing and planning, all they do is focus on what they know, which is just that, the world of money. That's fine when it comes to your profession or your niche and whatever it is that you decide to pursue. But I can tell you really quickly, you become really boring to talk to at parties, events. And once you start to diversify your understanding in a variety of facets of life, you indirectly will become a better investor and planner of your own finances, which brings me to the topic of today's episode, what I learned at the Berkshire Hathaway conference in 2024. Now, before we get into the four things, for those of you that do not know what the Berkshire Hathaway conference is, okay, there is the world's most famous investor, Warren Buffett, who is 93, 94 years old, and he has built Berkshire Hathaway, the largest conglomerate in the world. Berkshire Hathaway directly, there's only about 30 or so employees that work there, but indirectly with all the companies that Berkshire Hathaway owns, whether they're publicly traded stocks or privately held by Berkshire Hathaway, they oversee up to, I think they said 300,000 employees. So it's arguably one of the largest conglomerates in the world, and it's a pretty big deal. And every year, Berkshire Hathaway, which is headquartered in Omaha, Nebraska, which is where Warren Buffett was born, raised, grew up, and that's where he runs the business, everyone flocks to Omaha to listen to him speak for 6 hours on everything there is to know about Berkshire Hathaway. Now, it's much bigger than that because you're witnessing arguably the greatest investor of all time. And with that, the greatest investors in the world flock to Omaha. And so what I got to do, and this was just kind of my experience, this was my first time. I was actually invited indirectly by one of my past guests, Guy Spear, who hosts the Value X conference the day before. And so I went into this really without any expectation or preconceived thought. So that Thursday morning, I get up, I fly down. The second I get on the plane, I connect with this guy who's a real estate investor. We're talking about why we're going, and we immediately bonded and land. Go to my first event, see a lot of investors that have come on my show. Friday, more of the Value X conference, more people I've gotten to know over the years, even some celebrities. And then Friday night, you are going to dinner with people you just meet there for the first time. And then Saturday, you go to the Berkshire Hathaway conference. And some of these people are up at like 3 or 4 a.m. to get in line. And it's pretty crazy. Like when I was in line, I look over to my right, and right next to me is the CEO of Apple, Tim Cook. And the reason why there's a connection there, which we're actually going to talk about Apple in a moment. But Tim Cook, CEO of Apple, largest company in the world, and Berkshire Hathaway, their largest holding is Apple. So of course he's going to be there. But it's a pretty crazy experience because you're walking around, and whether it's Tim Cook, my buddy was in a Starbucks line, and he turns around and Bill Gates is right there because Bill Gates is best friends with Warren Buffett. There were CEOs of Wells Fargo, U.S. Bank, J.P. Morgan, politicians, celebrities, athletes, all of these people. It's not just an investment conference. It's really a philosophy conference. That's kind of what it's morphed into. And so it's one of those things start to finish. I had an absolute blast. I got to meet for the first time a lot of my fans, and I'm still getting used to that. Especially when people come up and they're really, really excited to the point where we're kind of like, okay, what are you going to do here? And I had some of my past guests remind me that, it takes a little bit getting used to. So for those of you that are fans, if I saw you and I was a little startled, I'm getting used to it, but I'm doing my best. Now, regarding the first thing I learned at this conference, and there were a ton of things I learned and ton of things I knew, but it was more like a reiteration. So I'm going to go through the top four. And the first one was the pursuit of genuine curiosity and perpetual learning brings together the best minds in the world. So this kind of ties in with the free tip of the day. There is nothing, I shouldn't say nothing, but it's definitely on my list of things I absolutely despise, is when you get stuck in a rut of a conversation and you kind of have to carry the team, because unless someone is just talking about that one thing, they're not multi-dynamic in conversation. And that gets pretty old pretty quickly. I can tell you right now, the people that go to this conference, not all of them, but for the most part, they are so well-versed in a variety of topics that I could have a conversation with someone for hours about anything. And you times that by the 40,000 people, shareholders, that flocked to this meeting, you're in conversational euphoria. But what's also really great is when you're talking to all of these people, and again, these are some of the most successful investment minds in the world, you quickly realize that they never stop becoming the student, the learner. They're always learning. They're never the master. And so I talk to people that, I've been doing this longer than I've been alive. And the first 5 minutes into the conversation, I catch myself answering all these questions that they have, even though I know they have infinitely more success than I could ever dream to imagine. And it's really humbling. So make sure that you are a perpetual learner, not just in whatever you're doing, but just in life, because frankly, you're going to be a lot more enjoyable to talk to. Now, the second thing I learned, and I want to take a step back. I learned it, but it's more of a reinforcement of my knowledge in this topic. But this is really good for you to know. There is always one more layer to think about. So I'm going to give a specific example, and hopefully compliance doesn't come back and cut any of this. So compliance, this is not investment advice. I'm not guaranteeing anything. I am just going off of my old little noggin. So on that Saturday, Warren Buffett talks about Berkshire Hathaway, and then he actually answers questions that he has no idea that are coming to him for 6 hours. And these are people that travel from all over the world. And one of the things that Warren was talking about is he sold in Berkshire Hathaway, but at the end of the day, he's the one making the decisions for now. He sold a little bit of Apple stock, which is their largest holding. And that created some unnecessary news. And he also sold some Paramount stock, okay? And people were talking about all of this commotion independently. And so what I mean by that is they're going, oh my gosh, he sold Apple. Well, why did he sell Apple? And they just focus on the Apple side. And then they think, okay, why did he sell out of Paramount? And then they just focused on that. They don't actually combine everything independently. So I actually wanted to go through, some of my thought process with that, as well as some other investors that I went to dinner with, and we talked about this stuff for hours. So Apple right now is a company that obviously is very well known and popular, and they are buying back a lot more of the company, meaning when there are less shareholders that own the company or less owners, each owner proportionally owns more of the business and gets more of the profit. And so one of the things that Warren did mention in his speech was, I could sell out this amount of Apple, and due to the rate that Apple is buying back the company, proportionately speaking, by the end of the year, I'm actually going to have the exact same percentage of ownership as I do right now, but I don't have to put up more money for it. It's kind of like a free rate of return, which was genius. Now, reason why I sold out of Paramount, there were a number of reasons why, but if you actually looked at it, what he sold out of Paramount at a loss was almost identical to the amount of Apple that he sold out at a gain. And so when you have long-term gains and long-term losses and those offset, you don't actually pay taxes, right, on that gain. So by selling out of that Paramount stock, all of that gain that he had will be deemed tax-free, all things being considered. Again, it's not tax advice, it's tax law. There's a tax rule called the wash rule, where if you buy back within 30 days of a loss, you actually are taxed at ordinary income rates. That's really not good, especially when you're dealing with billions of dollars like Warren Buffett. But the reason why I bring all this up is when you isolate one move in investing or planning, generally speaking, you're selling yourself short. And in most cases, it's going to cost you a lot of money. So always think about that next layer. So when you have something with money that comes up, you have to ask yourself, after you've established that this is maybe a smart decision to do, you have to ask yourself, how is this going to ripple through the rest of my financial plan? And hopefully that makes sense. And if you need to watch this over again, make sure you do, because that is mission critical. And that's going to separate you between you and a lot of your friends, in some cases family, that will choose not to put in the effort to think about that next layer in money moves. Now, there's one other thing that people need to think about too. So Mr. Buffett was talking about how he would like to have that cash from Apple. And with a company the size of Berkshire Hathaway, right? You got to think about it. Right now, I think their total cash, they have $182 billion of cash in the bank. So, and they're almost $1 trillion company. So for them to move the needle, they've got to do something major. They can't just go and buy a $10 million company, $20 million company. Heck, it's not even going to move the needle if they bought a $100 million company, or frankly, even $1 billion company, okay? And so they're thinking about massive, massive decisions. One of the key topics of discussion this year was Warren Buffett's longtime partner of, 70 years, I believe, Charlie Munger, died last year at 99 and 11 months, okay? Almost made it to 100. And so it was pretty somber, as a quick side note, because he wasn't there, right? The chair was empty. And I also think it added a layer of mortality to Warren that he really wasn't thinking about. Or if he was thinking about it, it just didn't hit him until your best friend is gone. And it's one of those things where Charlie's gone. Nothing has really changed at Berkshire Hathaway, so to speak. A lot has changed because he was a big decision maker, but Warren is the one running the show. When Warren Buffett passes away, Greg Abel, in my opinion, is going to be more than capable of running the company. He spoke a lot this year, and you got to give him some credit, because he tried filling the comedic shoes of Charlie Munger, and that just isn't going to happen, especially overnight. But the one piece that they talked about was a man by the name of Ajit Jain. And this goes back to the layers of thinking here, okay? And I promise this ties in. So Ajit Jain, and I think he's like 72 or 73, he runs their insurance division. And the insurance division of Berkshire Hathaway is the largest revenue producing asset that they have by a mile. Okay. And he's brilliant. I mean, he's considered the top insurance mind of all time. Now, the bummer with that is they don't have a continuation for him. In fact, Warren said almost verbatim, yeah, when Ajit's gone, you didn't say we're screwed, but we could be in some trouble. Now, the reason why I bring this up, and this is just going off of hunch here, on Sunday, I went to the Markel brunch, which is ran by a man named Tom Gaynor, who I absolutely adore. We're actually trying to get him on the show, which would be fantastic. You know, Tom's in his early 60s, and the reason why Markel is appealing is Markel is considered the mini Berkshire Hathaway. I mean, it's ran the exact same way, except it's a 20th of the size, something like that. But my point is, when you think about these layers, going back to what I said, you have to dig so deep to the point where you kind of know you've hit that metaphorical bottom. Because a lot of people would have just gone through the rabbit hole of Apple. They would have been done. A lot of people looked at the Paramount thing. They would have been done with that. And then some people would go as far as say, okay, why did they, now they've got all this cash, and then they just ended. Well, you've got to think as deep as you can. And the more you do so, the greater your net worth will become. Now, we're going to take a quick commercial break and give a break for our sponsor. And when we come back, we're going to close out with the next two things that I learned at the conference. So stick around and, give me 30 seconds.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. We're going to close out with the last two. I shouldn't say the last two, but the next largest two things that I learned at the Berkshire Hathaway conference of 2024 in Omaha, Nebraska, or shall we say the Middle East of the United States. So the third thing we learned, and by we, I mean me, okay? Don't have multiple personalities. This one's a bit technical, so you're going to have to buckle up, okay? Now, if you're a nerd and you love this stuff, it's going to be great. If not, I'm going to try to make it as entertaining as possible. But regardless of where you are on that spectrum, you're going to want to lock it in because it's going to add a substantial amount to your pocketbooks and your net worth. So when calculating and evaluating a business or a stock, or you could even say a piece of real estate, return on invested capital is one of the top starting points. I told you we're going to get a little technical. So one of the terms I can't stand is a term called EBITDA. If I had $1 for every time an alternative manager came to our office and started bragging about their EBITDA, I would be freaking loaded. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And I have a really crude metaphor of how to describe it, but due to the fact that this is a show that some children listen to, I'm not going to use that, okay? And so I'm going to try to clean it up a little bit. EBITDA is one of those things that you can disguise a lot of crap that's going on in your business. And it's one notch removed from revenue, which is what a company makes. So a lot of people assume, hey, if a company is making a lot of money, they're doing really, really well. Now, when you're a small business owner, yeah, that's great. And it's really, really simple. But when you're talking about a company or real estate investments where we're talking multi-millions and billions of dollars coming in, the top line number of revenue, what the company's making, that's not nearly as important as how well the company can invest that money prudently. And EBITDA just doesn't really show that, okay? Sorry for my merger and acquisition specialists, my CPAs out there, my M&A attorneys and investors that love EBITDA, okay? Get over it. It's not that great. So a lot of these investors like to use the term return on equity. And return on equity, the actual definition, and we're getting warmer here. Return on equity is basically, as far as an equation, you take the profit of what a business earns, and then you divide it by the equity of the business. So assets, what you own, minus liabilities, what you owe, is equity. And that number, that percentage will basically tell you what the rate of return is for every dollar that is kept within the business. So if you have a return on equity of, say, 30%, that means that whoever runs that business, the CEO or really the CFO, for every dollar you keep in the business, they're able to earn 30% on your money. Well, that's pretty doggone good, okay? Now, the bummer with return on equity is you can kind of fudge that number a little bit, and it can get messy. So we, at Capitalize Your Finances, the business, when we're analyzing companies, we've actually caught some CEOs and CFOs taking on a lot of debt on their business and then touting how their return on equity is skyrocketed. Remember, profit over equity. Equity equals what you own, assets, minus what you owe, which is liabilities. So if you put on a ton of debt into your business, that means that your equity is a lot lower. And if your profit is the same, you could show that your return on equity is growing, but all you're doing is taking out a boatload of debt to make yourself look a lot better than you actually are. So what we like to look at is return on invested capital, where you take the equity and you add the debt back in, because what that means is you're accounting for what the company is earning with your dollars, and there's nowhere to hide. The emperor has no clothes, okay? And that is one of those things where, did I know this before going into Berkshire? Yeah, I knew what return on invested capital was. But after listening to Guy Spear, I had an amazing coffee with Robert Hagstrom, which, as a fun little side note, a couple people asked, like, is that your dad? And Robert was really close to saying no, and I said yes, it is. So I'm sorry, Robert. It was really fun when it happened. But Guy Spear, Robert Hagstrom, Monish Pabrai, Gautam Bade, of course, Warren Buffett, Greg Abel, Brian Johnson, all of these famous investors were really honing in on the return on invested capital. And it was one of those things that really just put the nail in the coffin for me of going, okay, this should be one of the top items that you should look at before you decide if you should own a stock, a privately held business, or even a piece of real estate. Now, I want to caution you all with this. Just because the Cap and Capitalize said this is one of the places that I would recommend you start with before you go further, that should not mean that it is the only thing that you look at. There is a slew of metrics that you should be analyzing before you move on and decide if you should buy or sell one of those assets. And I'll tell you, even before you go through the return on invested capital and all of these numerical things, there should be and by should I mean there is a number of qualitative metrics that you need to ask yourself and verify before you move on to numbers. If you want something, and I'm not saying it's easy, but if you want something really cut and dry, my friend Adam Cecil, he's been on the show before, Where the Money Is, that's a great book to start with. And then if you combine that with Danielle Town's book, who is the daughter of Phil Town, a famous investor, and you know, she's a sharp cookie in her own right. She wrote the book Invested, very clever marketing. If you read those two books, that's going to give you a tremendous starting point, okay? But anyway, return on invested capital, that's a great place to start. And now you know how to analyze a business and figure out if these CEOs really are doing what is in your best interest or if they're full of crap. Now, the fourth and final thing that I took away from the Berkshire Hathaway conference of 2024, when in doubt, think even more contrarian. So I'm actually going to take it to the top of my trip. I get on this flight and I sit down with this real estate investor locally, Jeff, and I'm blanking on your last name. Sorry, buddy. And it was interesting because we were talking about just real estate in general. And as of this recording in May of 2024, interest rates have not come down. They're still high relative to a couple of years ago. And when interest rates rise, that's not exactly the best thing when it comes to real estate. And then you look at like the post-COVID world and all of that. I was talking to my new buddy, Jeff. That's another thing. At Berkshire, everyone becomes your friend. It's fantastic. And I was talking to him about, the value of multifamily, which is a hot area right now. Multifamily apartments aren't going anywhere. Again, not investment advice. It's just a fact. And then we were talking about warehouses, self-storage, data centers. And then we were talking about places that, of course, like I would stay clear of or not add anything more to, like, commercial space or office space, because that's what you see on the news. And there's some reasons for that, because, again, people aren't necessarily going into the offices as much as they were back in the day. And Jeff stopped me and goes, "Are you sure about that with the office space?" And at first I'm like, "Are you drunk? Like, you're in real estate. You should know better than anyone with this." But I heard him out. And after that, I totally got where he was coming from. Again, not investment advice. It just, you got to think about things. So, in real estate, in many ways, real estate can be a lot easier to value than a business because it's pretty cut and dry. And one of the great places to start when you're evaluating a piece of real estate is something called the cap rate, okay? And what the cap rate is, it's very simple. It's basically the rate of return that you are earning out of the gate the second you put your money in. So, for example, let's say that my lovely brother behind the camera decided to go and buy a duplex, and his cap rate was 8%. That means for every dollar that he put in, he's earning 8 cents. It's an 8% return on your money. Now, for those of you that have read our book and gone through the course, that's a pretty doggone good return. And it's one of those things where with cap rates, you would like to obviously buy when the cap rate is higher because that is a nice rate of return. And then when the cap rate gets to be really low, like in 2021, it was sometimes as low as 3%, or sometimes we saw 2%. That probably means that if your income stays here and your value has gone up, your cap rate has gone down, meaning you should probably sell out. Okay? So that's real estate in a nutshell. Cap rate, great. And that's not a play on words from the Cap and Capitalize. It's a bad dad joke. Not only the contrarian side of things, because again, this guy, brilliant guy, is looking where everyone else isn't. But then when you look and you actually do the math and then you dig deeper and deeper and deeper and deeper, kind of like what I was saying earlier, that's where the real money is. That's where the real money is. I mean, not to make this the Warren Buffett show, although right now it kind of is. So Warren Buffett bought American Express in the 80s. And he bought a boatload of it. I think actually he took like 40% of Berkshire's total portfolio, which, regardless of who you are, 40% of your net worth into one investment is pretty crazy. But when you're talking billions of dollars, it's borderline insane. And American Express had a, what did they have? I think they had indirectly an E. coli scare through one of their companies. And so people weren't necessarily using their services as much. And analysts were saying, oh my gosh, it's going to cause, consumer fright and all that fun stuff. And then Warren started asking just everyday people and no one seemed to care. And he did all the math and he went in and he went in hard. Same thing with Coca-Cola. We all know Coca-Cola as a company that has been around forever and they're very successful in the cola industry. And that wasn't always the case. And in the 80s, 70s and then up to mid 80s, Coca-Cola was, and this is Warren Buffett's quote, not mine, a great company ran by idiots. And it showed. Their return on invested capital was absolute crap. They were getting into businesses that they shouldn't have. And then they had this new CEO come in and recognize the really good brand that was that he had at his fingertips. And it took Warren about 3 to 4 years to really gain traction and comfort with this guy. And then in 1988 through 1990, Warren Buffett bought $765 million worth of Coca-Cola, which at the time was his largest purchase. And it was unheard of. And what was crazy about that was there was still this dogma of Coca-Cola not doing well within the community. And what was even crazier is not only was there that dogma and stigma of Coca-Cola was not a great company, the stock was at an all-time high. And you're thinking, okay, everything that Warren did seemingly at that point was wrong. That was the wrong thing to do. Okay, well, joke's on everyone because last year alone, he bought $765 million of Coca-Cola, okay? Hasn't really bought a ton since. Last year, so 30 years later, that same $765 million, forget the value, the dividends alone were $2.5 billion. So imagine your portfolio today, whatever the number is, okay? And then in 30 years, you don't add anything. The income alone is 2.5 times what your portfolio is worth today. That's insane. And guess how he did that? He went against the grain with everyone. And he actually, knew how to analyze the business, all that, and kind of the rest is history. But when in doubt, think even more contrarian. So those were the biggest takeaways I took away from the Berkshire Hathaway conference. I can tell you without a doubt, I'm going to be going back next year. I can't say too much right now because we're in talks with a couple groups, but yours truly may be speaking at a couple events next year. I know a couple of my buddies want to tag along with the Capitalized Posse. And for those of you that I met at the event, I thoroughly enjoyed meeting every single one of you. And I can't wait to continue conversations that we left off with in 2024, in 2025. And if you have any questions, you know where to hit me up. And as always, until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Guy Spear and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.